Industrial was arguably the hottest sector in commercial real estate just a few years ago, but today this asset class is going through a lot of changes. Factors like new construction activity, tariff-related uncertainty, and even consumer confidence levels are all playing a role in this and making it really hard for investors to figure out what's next. So in this video, we'll talk through some of the biggest shifts that are happening in the industrial real estate market today and the impacts these things are having on investors and occupiers right now. So the first thing we're talking about when it comes to industrial real estate is that new construction activity and new deliveries of industrial product have dropped significantly over the last few quarters, but leasing demand from tenants still isn't keeping up. In 2022 and 2023, we saw record high amounts of new industrial product delivered into the market, and as a result of this, we saw rent growth slow significantly and vacancy levels more than double across the country. But in the second quarter of 2025, new deliveries fell to just over 59 million square feet, according to JLL, which was less than a third of the new product delivered at the peak of the cycle back in 2023, and the lowest level of new deliveries on record since 2019. And according to Avis & Young research, the industrial construction pipeline has also dropped to levels we haven't seen since 2015, and with material costs sitting at over 40% higher than 2020 levels and interest rates staying higher for longer right now, it's been really hard to justify new construction activity. But even while new industrial deliveries have fallen off, demand for industrial space just hasn't caught up yet, and according to Newmark, over 46% of new industrial product delivered to the market since 2024 was still sitting vacant as of Q1 of this year. And in the second quarter of this year, net absorption in the industrial sector was just 23 million square feet, according to Colliers, which was over 25% less than the lowest quarterly net absorption figure we've seen in the last 4 years, with new leasing activity staying relatively stagnant since the start of 2023. Sublease availability of industrial space has also grown a lot over the last 3 years, with industrial sublease volume in Q1 of this year coming in at almost 4 times what it was back in Q2 of 2022. Corporate bankruptcies in Q1 of this year also came in at their highest levels since back in 2010, with retailers like Joann Fabrics, Rite Aid, and Forever 21 vacating a material amount of industrial space in multiple different markets across the country. It's also really interesting to note the demand for industrial product is the weakest right now for buildings with the largest square footage footprints, with vacancy levels for 20,000 to 100,000 square foot buildings coming in at just 5.3% in Q1 of this year, while vacancy levels for 250,000 square foot plus buildings came in at almost 11% at the same time. The bottom line here is that even though new supply levels are falling a lot in the industrial sector, this isn't having the kinds of positive impacts on rents and occupancy levels that investors would have hoped for by now, and it's really unclear when this trend might ultimately turn around. And speaking of uncertainty in the market, the next topic that's worth talking about that's directly affecting the industrial sector is the set of looming changes to trade policy in the US that could have significant impacts on both costs and consumer spending. In May of this year, the weighted average tariff rate on US imports jumped to its highest level since the early 1900s, and it's still not all that clear how these will ultimately shake out. And because of this uncertainty, industrial occupiers both have been and will likely continue to be really hesitant to sign new leases, which could put continued downward pressure on occupancy rates and rents throughout the industrial sector. And if costs for imported goods continue to rise due to increases in tariff rates, this could also result in another uptick in inflation in the US, which could end up hurting retail spending both in stores and online. And all of this uncertainty is coming up at the same time that the US consumer is feeling more stretched than ever financially, with household debt in the US jumping to a record $18 trillion in Q4 of last year, and consumer savings sitting at just 4.6% as of February of this year. The US housing market is also seeing huge drops in new construction activity, with permits and starts dropping to 5-year lows in May, according to Realtor.com, which is also putting upward pressure on home prices that are already unaffordable for a large portion of Americans. And with Home Depot being second only to Amazon in total industrial leasing activity back in 2022, This reduction in building activity has led to a material drop in demand for industrial product, with Home Depot actually giving back almost 5 million square feet of industrial space by the end of 2024. The key takeaway here is that the uncertainty related to tariffs and the impacts these could have are directly contributing to the lack of rent and occupancy growth we're seeing in the industrial sector today. Now, the last thing I want to mention in this video is a really big shift away from the trends we saw back in 2021 and 2022, and this is that the best performing industrial markets right now are inland metros away from the coasts. According to Newmark Research, the top 3 US markets for industrial absorption in Q1 of 2025 were Kansas City, Missouri, Dallas, Texas, and Phoenix, Arizona, and 6 of the 10 markets with the lowest industrial vacancy rates in the country were located in the Midwest. And from a rent growth perspective, while coastal markets like San Francisco and Los Angeles saw year-over-year rent decreases of 9% and 13% respectively, more centrally located markets like Chicago, Dallas, Fort Worth, and Detroit all saw year-over-year rent increases of at least 5% in Q2. Chicago also saw 1.4 million square feet of manufacturing leases signed in the second quarter of this year, which was the highest figure of any market across the country. Between March of 2024 and March of 2025, Texas, Oklahoma, Arkansas, and Louisiana saw a combined $60 billion of spending on manufacturing construction, which was higher than all Western U.S. states combined and more than 7 times the amount of construction activity that we saw in the Northeast. The key takeaway here is that industrial performance is the strongest right now in the central United States, and the markets that had been outperforming over the last few years are now seeing oversupply pressures that aren't being met by increases in demand. Ultimately, there are a lot of changes happening in industrial real estate right now, and I hope this is helpful if you're trying to make sense of everything going on. And if you want to learn more about analyzing industrial real estate acquisition or development opportunities, or you want to build the technical skills you'll need to land a job at an industrial-focused investment or development firm, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content like this on specific sectors of the real estate market, make sure to hit the like button and let me know. And let me know in the comments what you think the impact of tariffs will ultimately be on industrial real estate. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.